What do you think the most important stat is for a trader? Is it how much money they made? Is it how much capital they have? How often they win? Their biggest win? How fast they make money? The, the most important statistic for a trader is really how do they manage risk? And really, it's all about being in the game for the long term, surviving. Um, no matter what, if you're involved in the markets long enough, you are going to experience some wild swings. It's inevitable. You're going to experience really difficult market conditions. You can never control how much you're going to win, no matter what investment or trade you make. You never know going into it how much you're going to win. You have no idea. But the one thing you can trade with every decision, with every entry, is how much you're going to risk. I'm going to give you some tips that you probably haven't thought of. If you track your trades and you journal and you have a track record and you put on at least hundreds of trades, then you have an idea about your win rate, your win percentage, and you have an idea about your loss percentage. So that's a good start. How about average winners versus average losing trades? How about largest winning trade and largest losing trade? When you compile these statistics, this gives you a good idea of kind of your risk reward ratio and your profit loss and your kind of long term potential. Anyone can get lucky, and a lot of people do. The worst thing that happens to new people in the markets is they have a really big win early on. They take a lot of risk, they swing the bat, and they hit it big. And they think, wow, this is great. I'm going to be a millionaire in no time, and they forecast from there. But it doesn't really reinforce good principles and what you have to consider to survive for the long term. I'm going to give you some tips about how to manage your risk and maybe some things you hadn't considered. This will make you a little bit more well-rounded so that your risk-reward ratio will be more balanced and sustainable over the long term, no matter what kind of markets or what kind of trades you put on. So the first tip is don't use a fixed stop loss on your trades. Don't just make it some arbitrary kind of hard number. Oh, I'll risk half a point or a quarter of a point or a point. Have it make sense to the instrument. Have it make sense for the current market. Look at support and resistance. Look where other people are going to have their stops. You don't want to place it in an obvious spot where other traders are because those stops get run. The pros do it. They do it daily in low volatility. They run stops, and then the price comes right back out. So you don't want to do the obvious. You don't want to just do an arbitrary number. Oh, only risk a quarter point. Have it make sense based on the volatility, where support and resistance is, the average trading range of the instrument. My second suggestion is don't use daily profit targets. Don't even consider them. I'm guilty of this mistake as well. Um, when things are going well, I like to compute an average, how much money I can make every day. And then I can compute that out to the month and then the year. But the truth is, like I said at the beginning of the video, you don't know how you're going to do on any individual trade. And there's some fluctuations and some variations over a series of trades. If you're going to only put on 5 to 10 trades a day, you're not going to be able to just say, oh, I'm going to step out, I want to make $200 a day. It's going to vary. It's going to be one day you're going to be down a little bit, maybe one day you make 400, maybe one day you make 200, but don't shoot for, oh, I just want to make 200 today and quit. You should really be looking to exercise your strategy, take all the entries, don't just shoot for a goal of, I need to make this much money a day. You'll have a tendency to overtrade. And I'd almost say don't set expectations for the week. For myself, even if I were making 10 or so trades a day, which is probably a little under average, that's only 50 trades a week. There's going to be variation in there too. So don't set kind of expectations that are going to push you to take trades that you shouldn't be taking. My next suggestion is to consider your win rate and position sizing. So if you have a very win rate based on certain types of trades, um, the ones that you know historically are more often profitable for you, you should size those up a little bit more. And the ones that are less profitable for you, more risky for whatever reason, um, they should be a smaller size. I do it when things are crazy volatile. If there's some action in the markets, but I'm a little uncertain, it seems like price is moving really fast. Obviously, I'll trade a little bit smaller, and I don't just trade it smaller because I'm afraid. I'll trade smaller because um, there's a lot of risk. The price can move a lot faster than what I'm used to for a certain stock. And different stocks move in different ways. Obviously, if I'm trading Citigroup, it's a lot slower than Apple. My next suggestion is to take the spreads seriously. So whatever instrument you're trading, maybe you're trading stocks or Forex or whatever, but the spreads are an indication of volatility and they're an indication of risk. And sometimes they widen and you may not really recognize when it's happening. When news breaks or when things are a little bit more wild on some of those crazy days, the spreads will be larger. And that's just a warning sign. Maybe you need to adjust your risk there. Maybe it's a smaller position size. Maybe you don't stay in the trades as long, whatever it is. But know that the stocks that you trade, the ones that I trade often, I know what their average spread is. And I usually pick stocks that don't have a big spread. Um, but sometimes those fluctuate. Suddenly, something that usually only has a 2 cent spread has a 4 cent spread or a 6 cent spread. There's something going on. There's news or there's something in the markets where there's some sort of uncertainty. And while there's an opportunity for great profits, the risk is a little bit higher. So watch the spreads in your stocks and the ones that you know well. And if you're venturing out into stocks that you've never traded before because it came up on a screener or some kind of scanner, take a look at those spreads too. Make sure you're not getting in something that has a 10 cent spread. It's a lot of cost to overcome on an individual trade. So consider the spreads, take the spreads seriously, pay attention to them. And if for some reason they widen, and it's a little abnormal, be a little bit more risk averse. My last suggestion is throughout the trading day, if you're a trader who puts on multiple positions, consider correlations. By that I mean stocks that are in the same industry um, or in the same sector. If you have multiple positions on, say, semiconductor stocks, they're probably going to act very similarly. And you're increasing your risk by putting on multiple positions in the same direction in those stocks. So be aware of that. If you like to trade AMD and Qualcomm at the same time, they're both chips. You throw Intel in there, and now you've got 3 chip stocks. On normal days, nothing crazy, no news on any individual one, they're probably going to behave very similarly in price. So suddenly you have triple the position size of essentially maybe the same idea. But that's what I have for you today. I just want to give you some ideas about how to manage your risk and control your risk. It really is the most important step. It's not about how much money you make. It's not about your biggest winner. It's about staying alive for the long haul and doing the right thing day in and day out and managing your risk. Extreme events do come. Every 3, 6, or 9 months, there's always some kind of extreme event in the markets. And if you're not managing your risk when those happen, you have the potential to lose a lot. Half of your account, a large portion of your winnings for a year even. These could be tweets from the president. It could be the Brexit vote risk. So you have to stay on guard. Risk is the most important stat. How do you manage it? How do you measure it? Are you consistent? Are you protecting your account, the tool that you use to make more money? It's your money. It's your capital. So exercise good risk control. I hope this is helpful to you. I'll see you next time. Leave your comments down below if there's some other topics you'd like to talk about. Let me know. Thanks again and good luck out there.